Hi everybody, Brian here for Wednesday 10 p.m. October 17th. First article of tonight, the analysis, global markets. Asia shares swoon to 19-month low. Investors await U.S. data. This is found now on October 11th. A little old, but I think it's still valid. And let's go through this. This is from CNBC.com. Headlines that we all know. I'll just do the ones that are fairly still valid. High yield, bond yields, China, U.S. trade tensions weigh. We know that. Yen and euro in demand as safe harbors. Dollar mixed. Interesting, I find that the euro is now looked upon as a safe haven. The Japanese yen we've always known about. Okay. Asia Pacific shares off 3.8%, excluding Japan. IMF head Christine Lagarde says the stock market valuations have been very high. It's erased hundreds of millions of dollars of wealth around the region. Equity markets are locked in sharp sell-off with concern around how far yields will rise. Warning from the IMF about financial stability, risks, and continued trade tensions, all driving uncertainty. That's an analyst at ANZ. You can see here Nikkei dropped 3.9%. Shanghai shares dropped 4.9%. Taiwan 6.3%. Seoul, Korea, Kospi down 3.8%. Further short-term equity pain shall be unavoidable in South Korea as foreigners are selling, but bond market is holding up. So we'll talk about that in a minute. We're all watching the Fed, watching the U.S. economy, worrying about the inflation spike, wages spike that will come through. Wiped out. Wow, $850 billion of worth as technology shares drop. We all knew about Trump and his Fed is not happy with what the Fed's doing. And here's the concern right now. Rising treasury yield has been the primary catalyst of sell-off in equities since higher yields suggest a lower present value of future dividend stream, assuming an unchanged economic outlook. It is possible that equity investors are growing concerned that the Federal Reserve projected rate path will choke off the expansion. China has suspended approvals for overseas investment product in Shanghai. License holders JP Morgan, Asset and Aberdeen Standard to be low profile in marketing it as concerns rise in Japan and Beijing over possible outflow pressure, allowing yuan to gradually decline, breaking the 6.9 barrier, leading speculators to push up to 6.9377. Offshore yuan was at 6.93 per dollar, pips 65 pips weaker than the onshore close. This is all last week. So dollar was losing ground to both the yen and the euro. Euro was up 1.115 from a low of 1.1429. Dollar lapsed to 112.17, telling a retreat from last week's peak. Prices of oil's gone up. It went down, and gold has gone up. So as I said, let's do the bonds here at the GlobeMail.com. Article is, when was this come out? This came out at the same time. Tide turns for bonds. Volatility brings a spotlight back to fixed income. Now again, this is a Canadian newspaper. Quote here, we're definitely seeing rising rate environment, but the market has already priced in a lot of rate hikes. ETFs, best way to participate in the bond market because of diversification, price transparency, ease of trading, and relatively low cost. So everything's all about ETFs. Investors look for stability, and bond ETFs face a conundrum. Notes: main reason to hold bonds is to buoy your portfolio when the market fails. The only bonds with little or no positive correlation to the market are long duration government bonds. The very ones that are vulnerable to interest rate and inflation fears. It's already happening. Bond price fears to fall when interest rates rise. Bond duration is a measure of how much bond price could change if interest rate price rise or fall. Longer the duration, the more sensitive the bond price is to rising or falling rates. So suggestions of what to do. Here for investors, important to be clear about the difference between core bond holding and more tactical ETFs. Core ETF is long-term holding that provides income, lower volatility, and serves as a counterbalance to stock markets. Tactical ETFs tend to be designed to boost yield, provide monthly income, or take advantage of changing circumstance. Interest rates are so low, many investors have abandoned their core bond holdings for tactical funds. Tactical funds tend to be positively correlated with other risk assets such as stocks. That means when the stock side of your portfolio falls, the fixed income tends to fall as well. So on and so forth. Quite a long article, but you kind of get the idea of what to do. But if you want, you know where to go. Talk to you later.